But the key words were, and they survive, right? There's a little trap there, because you have to catch those three words. If you buy single B bonds that don't survive, then you're in big trouble. So, but it's obviously, it's tautologically true that if a company about which the expectations are low survives, it'll probably, at minimum, it'll pay off at maturity, and maybe in the meantime, it'll be upgraded or taken over if they survive. So what that convinced me when I was starting the high yield bond business, and this conversation came at a great point in time, is that my analysts should spend all their time trying to weed out the ones that don't survive. Not finding the ones that will have favorable events, but just excluding the ones that have unfavorable events. And that's what we did. So now, I'll tell you an interesting story. Around 05 or 06, the Bible of investing is a book called Security Analysis, written by Graham and Dodd. And they wrote the first edition in 1934. Ben Graham was Warren Buffett's teacher at Columbia, and in many ways the father of value investing. He and David Dodd wrote this book in 34, and they updated it in 40, and then several times after. And the 40 edition is considered to be a great edition. And so in 05, McGraw-Hill, which owned the book, said they want to update the book. And they turned it over to Seth Klarman, who's a great debt investor in Boston at Baupost, and a professor, can't remember his name right now. What? That's right, Bruce Greenwald at Columbia. So you should be up here, I'll sit down. They turned it over to Seth and Bruce to bring out this revision, and they in turn asked people to revise the sections, and they asked me to revise a section on debt. And so that meant I had to go and read the 1940 edition in order to update it. And I came across something fascinating, and it verified what I had always thought. It said that bond investing is a negative art. What does that mean? What it means is, I don't know how many of you know how bonds work, but a bond is a promise to pay. You give me $100 and I promise to give you 5% interest every year and then give you money back in 20 years. Fixed income, it's called, because all the events are fixed. The contract is fixed, the return is fixed, assuming the promise is kept. So all 5% bonds that pay will pay 5%. No will pay 6, none will pay 4. All the ones that pay will pay 5%. What does that mean? It means it doesn't, of the ones that pay, it doesn't matter which ones you buy. I'm going to like this one. I like that one a lot. That pays 5. I like that one. That pays 5. It doesn't make any difference. You're not going to be a hero by choosing among the bonds that pay. The only thing that matters is to exclude the ones that don't pay. So if there are 100 bonds, 90 will pay. They'll all pay the same thing. It doesn't matter which of the 90 you choose. The only thing that matters is excluding the 10 that don't pay. Negative art. The greatness of your performance comes not from what you buy, but from what you exclude. So I thought that was very useful. I should have that up here too. But anyway, so that Milken was my fourth input. So Taleb says that the future consists of a range of possibilities with the outcome significantly influenced by randomness. And Galbraith says that forecasting is futile. And Ellis says that if the game isn't controllable, it's better to work to avoid losers than to try for winners. And Milken says that holding survivors and avoiding defaults is the key in bond investing. So if you put them all together, that's how you get the philosophy that's in the book. These were my origins. So when we started Oaktree, April the 10th of 1995, almost exactly 20 years ago, we wrote down our investment philosophy, and here it is. We published it. We were a bunch of guys who had been working together for most of the previous 10 years at a different employer. And we left there as a group, and we started Oaktree. And so for a philosophy, so I believe in writing things down, and like learning at the Lou says today, write them down, right? So we wrote down our philosophy. We published it. We'd never changed a word since. And the clients liked knowing what our roadmap is. So these were the 6 tenets of the investment philosophy. So the first one says that the most important thing is risk control. And we tell the clients, we think that for excellence in investing, the most important thing is not making a lot of money. It's not beating the market. It's not being in the top quartile. The most important thing is controlling risk. That's our job. That's what we'll do for you. And the clients come to us who want to invest in our asset classes with the risks under control. There are other people who put less emphasis on controlling risk, and they have better results in the good times and worse results in the bad times. Our clients want what we give them. Number two, we have an emphasis on consistency. So we say we don't try for the moon at the danger of crashing. You know, the first memo that I wrote in 1990, I'm sure you remember that, Rob, talked about a guy who was head of an asset manager that had a terrible year. And he said, well, it's very simple. If you want to be in the top 5% of money managers, you have to be willing to be in the bottom. I have no interest in being in the bottom 5%, and I don't care about being in the top 5%. I want to be above the middle on a consistent basis over the long term. And there's a funny bit of math. This will confound the, what do you call yourself, data scientists? This will confound the data scientists in the room. But so in that first memo, I contrasted the comments from that money manager with a comment from one of my clients who told me, right about the same time, it was the juxtaposition that caused me to write that first memo. He told me that for the previous 14 years, his pension fund had never been above the 27th percentile or below the 47th percentile. So it was solidly in the second quartile every year for 14 years. So let's see, 27, 47, the average of that is 37, right? What percentile do you think that fund was in for the whole 14 years? 4. And if you think about it, it's really almost mysterious. Why the 4th, not the 37th? And the answer is that when people blow up, they really blow up. And so we said we want consistency. We want to be a little bit above the middle all the time. Maybe we'll pop up to the top in the years when the markets are terrible and our risk control is rewarded. But we think that over a long period of time, we'll be very respectable that way, and our clients will have an absence of bad experiences, which I think for them is very important.